Hi, I'm Cathy McBreen, president of Millionaire Corner, and we're delighted today to have an investment manager just talk to you about what's happening in the fixed income market. I'd like to welcome Aaron Izenstark. Just so you know, Aaron is the co-founder and chief investment officer of Iron Financial. He's responsible for the oversight of Iron's investment management, research, and trading capabilities, and for the oversight and management of the firm's approximately $1.9 billion. Prior to co-founding Iron Financial, Mr. Izenstark was a member of the Chicago Board of Trade and the Chicago Mercantile Exchange, where he specialized in the trading of fixed income and equity derivatives. Welcome. We're really glad to have you here. It's nice to see you.
Yep.
So what should the average investor look for in the next 3 to 4 months as they start to see all of this happening in the market? Will probably be a little volatile.
Yeah, and it has been. I mean, I think at the end of the day, the investor needs to really think about what fixed income is, which is that's why they call it fixed income. You're getting income off of something you're expecting to hold to maturity. And so don't look for yield only, because if you're only looking for yield, then you're going to probably have a tendency to buy a bond that's either too long or the credit quality is not good enough for you to actually hold to the maturity to get to all your money back. The other part of it is that if you're going to create a portfolio, you probably want to create some kind of a ladder that goes from 0 to 5 years and has a mix of securities from that 0 to 5 years. So if interest rates do go up over time as bonds mature, you can then invest in a higher yielding security with where the market is at that point in time.
If someone's at the point in their life where they're at retirement age, is a bond ladder a good idea for them? And if so, how would they? I assume they should talk to a financial advisor, but are there any tips for someone like that, and if this is a good time to do something like that or not?
I definitely think so. I mean, again, you can do it if you're an individual investor and you want to take no risk. You can buy all government guaranteed securities or CDs, types of things that have the government backing on them. You're going to give up a lot of yield to do it. So that's why, again, if you're buying bonds just for the income, we think it makes sense for the investor to look at investment-grade bonds, because the investment-grade bonds will give you percentage-wise a lot higher yield than a government-guaranteed CD, but also it will allow you to diversify the portfolio enough that you can feel comfortable that you're not buying one bond in the portfolio. And I think if you look back in my early days in the 80s, when rates were, you could get 8 or 9% on a money market fund, you tended to have people do that. They bought a few positions in their portfolio. But then what's happened over time with a bond defaulting, and people realize, okay, well, maybe this is not the smartest idea. So if you're going to buy a portfolio of bonds, it makes sense not to buy a security that is more than 3% of your overall position, and maybe even smaller than that. And that's why monitoring all this usually takes a professional. There are institutions that are selling that you could do this yourself, but the problem is if there's a changing quality of the company, usually the individual investor's not going to be able to react quick enough to make a change in their portfolio, and they're going to only react after something happens, and it's too late when that happens.
Well, that's a great tip. Do you have any predictions about how high interest rates might go?
That's probably the $64,000 question, or everybody's trying to figure that out. But I think that a normal level, if you get to where the Fed is not in the marketplace, I wouldn't be shocked to see mortgage rates at somewhere between 5 to 6% again, because that's probably a low normal level, where right now is way below what it's been in the norm. So if that happens, again, you're talking about a 4+% 10-year Treasury type of investment, and that would be normal, because right now what you have is the Fed buying $45 billion a month plus in mortgage-backed securities and $40+ billion in Treasury securities. So when you stop doing that, naturally rates are going to rise. So and that would probably be good for income buyers too, because they gives them more income to spend.
Yeah, exactly. Chairman Bernankes is allegedly going to retire at the end of the year. Do you have any opinion about how that change is going to affect the markets, or what would be good for the markets or bad for the markets?
I think, generally speaking, the market is expecting, doesn't like change. So it's expecting that the transition will be smooth, and who they put in there is probably going to be similar to him. That's what I would say the expectations are. If it's much different than that, then you're probably going to see more volatility. And usually that means, not good things for the market and a lot of uncertainty. So I would say that given that the players like Bernankes and the ones before him, which I'm sure they will be conversing, will try to put pressure on the markets to be as smooth as possible. And that just means a smooth transition and don't shock the markets. And they're trying to be very open door with, they release their minutes and as the Fed meetings are ending, and then he does a press conference afterwards. I would say that the goal is to keep things as smooth as possible, and that's usually, I think at this point, that's what is most likely.
So do you think the end of 2013 and the beginning of 2014 will be a good time for fixed income investments, or?
I think if you need income, it's always a good time for fixed income investments because you don't have a choice. And the thing is the big difference that people have to focus on is a bond fund and an individual security and what those risks are. And so if you buy decent quality bonds and you're able to hold them to maturity, then it really doesn't matter where they fluctuate in between. And that's why I say put a ladder together if you can, and that helps you to stomach the volatility and also if interest rates rise. If you buy a bond fund with a perpetual duration, you could lose money over time, and it's, in my opinion, it's not the best thing to take income off of, because if you're taking income out of it and interest rates rise, you're actually not being able to reinvest at those higher rates to stem the loss of principal. So if you're taking income off of fixed income investment, it makes the most sense to create a bond portfolio of individual securities that are maturing at the same time you are recycling and maybe using some of the interest.
Okay. Is there anything we haven't talked about that you think our investors would like to know about?
Well, I think probably the only other piece of it is coined as the alternative space at this point. I think the thing that makes the most sense to do is questions have come up. Is there opportunities if interest rates rise to make money with rising interest rates or falling credit? And there are, of course, investor opportunities to do that, but those are probably the tougher types of strategies to do your due diligence on. In those types of things, I would focus on, if you're going into an alternative investment, focus on something that is liquid and has liquidity all the time, which typically means it's going to be a 1940 Act or a registered investment. And I think what happened in 2008 is you had many investors that before that were pushing for higher yields, and there was a lot of limited partnership type investing, and when the market melted down, not only was their liquidity choked off, but they had to wait for many years, and some are still waiting for securities and funds to open up and be liquid. So if you're going to look at some of those alternative types of investments, it makes sense to look at a liquid investment that, again, is SEC registered, that you can push the button to get in and push the button to get out.
Great. So Aaron, how can an investor take advantage of interest rates as they're beginning to go up?
Well, there's primarily two ways. The first way is a more standard way, which is you create a bond ladder. And in this environment, it makes sense to create a short duration bond ladder. So that means having bonds that have an average duration in your portfolio from 2 to 3 years. Usually you're buying bonds from anywhere from 1 year to 5 years, and it has the average in between. And so it allows you to recycle by buying higher, longer-term bonds at higher yields when your other bonds mature. The other more current way, which is popping up all over, is if you go into a systemic rise in interest rates. So what happens if this continues over the next 5 years? The Fed stops buying bonds, rates continue to inch up, and you see what you've seen over the last couple quarters, which is significant losses in bond indexes and bond portfolios. So what do? The other option is what's coined as an alternative investment, and there's plenty of, again, 1940 Act funds that you can push the button in and push the button to get out. They're registered. You can buy them in any brokerage account, and typically what those types are doing is looking for maybe credit opportunities where you're buying below investment grade credit, but also you might be taking advantage of moves in the yield curve. And so something like that is going to be using derivatives to hedge the portfolio, which is going on in most mutual funds to adjust the duration. But in this case, they might be trying to take advantage of a changing yield curve, which means what's happening at the 5-year rate, what's happening at the 30-year rate, and how that spread is moving, and also maybe trying to capture some higher yields in below investment grade securities, but by also buying some protection on that portfolio. So if interest rates do rise, you can, or the bonds do start to fall because of concerns, economic concerns, you actually can stop the losses or lessen the losses. So that's a big part of what's going on in the industry right now.
So this is part of what your firm specializes, is that correct?
Yes, yes.
Great. So if any of you are interested in learning more about fixed income and how to take advantage of the rising interest rates, go to ironfinancial.com. Thanks for watching.